sending money back home can unexpectedly place you under investigation, and there are hidden rules that many immigrants have never been told about. A 58-year-old man walked into a Western Union branch in Edison, New Jersey, just as he had done every single month for 9 years. The amount was always the same, the recipient never changed, and the reason remained consistent. He regularly sent $2,800 to support his elderly mother in India, along with his younger brother's family. He worked long 12-hour shifts managing a Dunkin' Donuts franchise. As a green card holder, he followed the law and filed his taxes properly every year. Then one day, his bank account was suddenly frozen, with a notice stating suspicious activity review pending federal inquiry. Within 48 hours, 2 agents from Homeland Security Investigations were sitting outside his Dunkin' Donuts location in Woodbridge, holding a folder with 73 pages of documents. Inside were every Western Union receipt, every bank statement, and his last 4 tax returns, showing total transfers of $291,000 over 9 years. They compared that to his W-2 salary of $44,800 per year and asked a simple question. How could someone earning $44,000 send nearly $291,000 abroad? He had a completely legal explanation. He co-owned the franchise with his wife, who had her own income, and he also earned rental income from a small property in Queens, all of which was properly reported on his taxes. Everything was legitimate, but that didn't stop the process. The investigation had already begun, a report had already been filed, and his name was already in a federal database. Under a data sharing agreement between the IRS and ICE, the same tax return that proved his innocence was the document that first put him on their radar. He was eventually cleared after 11 weeks and $9,000 in legal fees, but during that time, his accounts remained frozen. He couldn't pay suppliers, couldn't make payroll, and couldn't send money to his family. His 79-year-old diabetic mother went without financial support for the first time in nearly a decade. This is how the system works today, not just affecting criminals or traffickers, but ordinary people running small businesses and supporting their families. The most alarming part is that he did nothing wrong. He didn't hide income, didn't structure transactions, and filed every tax return on time. Still, he was investigated because the rules had changed and no one informed him. In this guide, I will explain everything he didn't know. 5 rules, 5 common traps, and 5 ways to protect yourself. By the end, you will clearly understand how the United States tracks money sent abroad and what steps you need to take to avoid becoming the next case. Let's begin. The $10,000 rule is something many people have heard about, but very few fully understand. Under the Bank Secrecy Act, every financial institution in the United States, including banks, credit unions, check cashing services, Western Union, MoneyGram, and other transfer providers, is required by federal law to file a currency transaction report, or CTR, with the Financial Crimes Enforcement Network, FinCEN, which is part of the U.S. Treasury. This report must be filed whenever a customer conducts a cash transaction of $10,000 or more within a single business day. It doesn't matter whether the transaction is a deposit, withdrawal, exchange, or transfer. Once the total amount reaches $10,000 in a single day, a report is automatically generated and submitted. Many people misunderstand this rule and assume they can avoid it by sending amounts just under the limit, such as $9,999. That assumption is incorrect and can actually lead to serious legal trouble. Deliberately breaking transactions into smaller amounts to avoid reporting is considered a federal crime known as structuring, defined under Title 31 of the United States Code, Section 5324. The law clearly states that no person may structure transactions for the purpose of evading reporting requirements. The penalties are severe, including up to 5 years in federal prison and significant fines. A real example involved a convenience store owner who was sentenced to prison after making multiple cash deposits just below $10,000. The bank identified the pattern, filed a report, and the IRS Criminal Investigation Division opened a case that ultimately led to his conviction. The lesson is straightforward. Do not attempt to bypass the system by splitting transactions into smaller amounts. Financial institutions are trained to detect this behavior, and their systems are designed specifically to identify such patterns. Even if each individual transaction is below $10,000, the bank can still file a Suspicious Activity Report, or SAR, if they suspect structuring, and that report is sent directly to FinCEN. Now, there is another threshold that far fewer people are aware of, and it is especially important for immigrants. FinCEN issued an alert focused on cross-border fund transfers involving individuals suspected of unlawful activity. According to this guidance, money service businesses, including Western Union, MoneyGram, check cashing locations, and other transfer operators, must file a suspicious activity report for any transaction of $2,000 or more if there is reason to suspect the funds come from questionable sources. This means the relevant threshold is not always $10,000. It can be as low as $2,000. If you send $2,000 and the agent handling the transaction has concerns about the source of funds, they are legally required to file a report. The alert outlines several red flags, including frequent transfers in round amounts, transactions that don't match the sender's stated occupation, sending money to multiple recipients in the same region, using different locations to avoid detection, or providing incomplete or inconsistent identification. When you think about it, many of these factors can apply to ordinary law-abiding individuals who simply send money home regularly. For example, someone working in construction, driving for rideshare services, or working in a restaurant might send $1,500 to $2,500 every month. To an automated system, that pattern could appear suspicious. What makes this more concerning is that these reports don't remain isolated. Under laws like the USA Patriot Act, SARs can be accessed by hundreds of law enforcement agencies, including ICE, Homeland Security Investigations, and the FBI. A major development that intensified this process is the data sharing agreement between the IRS and ICE. Under this agreement, ICE can submit names and addresses of individuals they suspect may be undocumented, and the IRS can cross-check that information against its taxpayer database, including W-2 forms, 1099s, and tax returns. The IRS then provides confirmation of identity, address details, and employment information. In one batch alone, ICE submitted over 1 million names, and tens of thousands were verified and shared back. This means tax information, originally submitted to comply with the law, can also be used for enforcement purposes. In some cases, even errors have occurred, with data being shared beyond what was intended. When you connect all of this, a clear picture emerges. Filing taxes, reporting income, and using identification numbers can all contribute to creating a detailed profile that can be accessed across agencies. On top of monitoring, there is also a financial cost. A 1% excise tax applies to certain remittance transfers sent abroad. This tax is paid by the sender and typically applies when transfers are funded with cash, money orders, or cashier's checks. However, transfers funded through a U.S. bank account, debit card, or credit card are generally exempt. For example, sending $500 in cash each month would result in an additional $5 per transfer, adding up over time. For individuals who rely on cash because they lack access to banking services, this creates an added burden. At the same time, those transactions may also fall under increased monitoring thresholds, meaning individuals can face both higher costs and greater scrutiny simultaneously. Understanding how enforcement works is important. A typical sequence might begin when a transaction triggers a report, which is then analyzed for patterns. If multiple reports or inconsistencies appear, information may be shared between agencies. Discrepancies between reported income and transfer amounts can lead to further review, and in some cases, investigations may follow. This can involve reviewing records, contacting employers, or requesting additional documentation. In some situations, even a single transaction around $2,000 could initiate this process. To reduce risks, there are several practical steps individuals can take. Using electronic transfers from a verified U.S. bank account can lower both costs and the likelihood of reports. Avoiding structuring is critical. Never split transactions to bypass thresholds or use multiple locations for the same purpose. Keeping detailed records of income, including pay stubs, bank statements, and tax documents, is essential in case questions arise. Filing taxes correctly and on time remains important despite data sharing concerns, as failing to file can create additional legal issues. Consulting a qualified tax professional who understands these dynamics can also be helpful. In some cases, opening a joint bank account with a trusted family member who has proper documentation may provide safer transfer options. Looking at real-world scenarios highlights the difference. Someone without a bank account who sends $2,000 in cash each month may pay additional taxes and fees while also increasing the likelihood of reports being filed. In contrast, someone using electronic transfers from a verified account may avoid certain taxes and reduce scrutiny. The difference is not only financial but also related to overall risk. Finally, it is important to mention informal transfer systems, which are used in some communities. While they may seem convenient, operating or using unlicensed money transfer services in the United States can carry serious legal consequences. Authorities consider these systems higher risk, especially when combined with other factors that have already drawn attention. Staying within the formal financial system, even if it involves higher fees, generally provides greater protection when proper documentation is maintained. In summary, the commonly discussed $10,000 rule is not the only concern. Lower thresholds, reporting requirements, data sharing practices, and additional taxes all play a role in how money transfers are monitored. Every transaction can potentially be tracked, analyzed, and shared across agencies. This is not speculation. It is based on established laws, regulations, and documented practices. The most effective approach is to stay informed, maintain proper records, follow legal requirements, and use safer transfer methods. Sharing this information with others is important because many people remain unaware of how these systems operate.